Welcome to today's broadcast of In Conversation with Dr. Sherry Cooper. We'll be exploring the world of mortgages in Canada and why it's important to have a deep understanding of this topic. To guide us through this conversation, we're joined by Dr. Sherry Cooper. Dr. Cooper is a renowned economist, financial expert, and best-selling author with over 30 years of experience in the industry. She's also the chief economist at Dominion Lending Centres, Canada's largest mortgage company. In this episode, Dr. Cooper will provide us with valuable insights and expert analysis on the current state of the Canadian housing market, the impact of interest rates on mortgages, and the importance of working with a trusted mortgage advisor. We'll also delve into the services offered by Dominion Lending Centres and why they're an invaluable resource for anyone looking to purchase a home or invest in real estate in Canada. So whether you're a first-time home buyer, a seasoned investor, or simply interested in the world of finance, this broadcast is sure to provide you with valuable information and insights that you won't want to miss. So sit back, relax, and join us as we dive into the fascinating world of mortgages with Dr. Sherry Cooper and your host, the president of Dominion Lending Centres, Eddy Cocciollo.
All right, welcome everyone to ICW here, October. Although we all anticipated that there was going to be a change in interest rates, I think a lot of us were on pins and needles. It just seems like, man, we did need a relief, and we sort of got one today without an increase. Sherry, I think you anticipated this. I think you've anticipated most of them, and you weren't wrong this time. They did not increase rates today.
Right, Eddie. I don't think any economist was expecting that they would, and mostly because the Canadian economy has slowed, and the incoming data are showing that excess demand has diminished, and inflation at least is heading down. So no rate hike, but of course, it was still a very hawkish statement because they continue to say that they may raise rates again.
Well, on behalf of all the variable rate clients out there and potential purchasers, we are all going, thank God that there was no increase. So as usual, if you have questions, please send them. We won't get to your questions until after Sherry finishes her presentation. And as usual, Sherry, let's start with you, and we'll get back to questions as soon as you finish.
Okay, well, thank you. As I just said, no real surprises in terms of what the Bank of Canada is doing. They finally acknowledged that excess demand is no longer a problem. So the economy certainly has slowed. Since the second quarter data, we saw a considerable slowdown in economic activity. And the bank put out its monetary policy report today, where they do list their forecast and projections for economic activity globally and in Canada. And they agree that we are seeing a slowdown in economic activity that has reduced consumption, and particularly in the most interest-sensitive sectors of the economy. So I haven't changed my forecast, which is that economic activity will be very slow. It has already begun to slow. We saw retail sales, for example, down sharply, and that slowdown will continue as we get the data for the third quarter, and then on to the fourth quarter of this year and the beginning of next year. The bank has somewhat more optimistic outlook over the near term. But in both cases, this would be a soft landing. Interesting because prior to this, most economists on Bay Street were suggesting that we would see a recession. In fact, the recession would have started by now. But that's just not the case. And we may well get through this tightening cycle without triggering a recession. Canadian consumption has been flat. We've got weak retail sales. This is a big, important number. And as a result, indeed, the GDP figures are likely to come, the growth numbers will come down. Canadian households are hugely interest rate sensitive, much more so than in other countries, particularly the US, because all Canadians have 5-year mortgages typically, or even less than 5-year refinancing. So as people are refinancing or just renewing their mortgages, they're going to see an uptick in their monthly payments, and in some cases a very large uptick, particularly as we get into 2005 and 2006. But even this year and the coming year, it's likely that monthly payments for people that had variable rate fixed payment loans will double, which is tough for most households. Now, yes, household debt to income is near record highs in Canada, but on the flip side of that, household net worth has also never been higher, even with the modest correction we've seen in home prices. Household borrowing has declined sharply, particularly when we look at mortgage originations, which, given the latest data available, which only takes through to July, we see that mortgage originations fell to an 18-year low, and that for the Greater Toronto area and Greater Vancouver area, below pre-pandemic levels is what we're seeing in terms of originations. And hardest hit by the slowdown, of course, are the first-time home buyers. Those are the ones that haven't benefited from the increase in wealth associated with owning real estate, residential real estate. So another component to the slowdown is that monthly payments have already increased. Debt service ratio has been rising sharply. This has affected those who have adjustable rate mortgages, no fixed payment guarantees. It's hit them the hardest, but it means they've cut back on discretionary spending in order to be able to make those monthly payments, because delinquency rates on mortgages are still at historically low levels, although we've begun to see some shorter term delinquencies. In other words, not delinquent the full 90 days, but maybe 30-day delinquencies, which is a leading indicator. In addition, the savings rates have moved up. And so consumer spending, again, the flip side of this is that consumer spending has slowed and consumer confidence has declined. And as well, credit card delinquencies are rising sharply. And remember, people who are paying interest on their credit card debt are paying 20% interest rates, which is just, it's usurious, really, but it's unfortunately too many Canadian households are relying on their credit cards to make ends meet, which is certainly an imprudent activity for the longer run, because the interest rates are so high, you're paying interest on your interest going forward. It's really tough to get out of that kind of debt. We've also seen that consumer and business insolvencies are rising, which again is exactly what you'd expect in the wake of an economic slowdown. There's been some easing in Canadian labor markets, although as the monetary policy report released today by the Bank of Canada continues to say that labor markets are still relatively tight. We've seen, though, that the jobs numbers did rebound in August, the latest data available, and I'm sorry, it's in September, is that 39.9 thousand increase. So it's ticked up. And in addition, we've seen that the jobless rate has held steady for a considerable period of time. So 5.5% unemployment is still very close to full employment. And by the way, prior to the pandemic, the unemployment rate in Canada was at 5.7%. So it was higher, in fact, than it is today, just suggesting, how we continue to see relatively tight labor markets. Job vacancies, though, have been falling for more than a year. They've come down sharply. Not so much, by the way, in the construction sector. And that is hugely important for the outlook for housing, because we know we have extreme excess demand when it comes to housing, be it either for rent or for purchase. And it's really tough to step up construction activity when you don't have sufficient laborers to do the jobs. And that's why an estimated 3/4 of the current construction programs that are ongoing for condos in Toronto are now 2 years behind schedule. And that means these are projects that are already in the ground and they're working on them. It's taking longer than anyone expected because it's so tough to find skilled labor in that sector. So though there's been an easing in labor market tightness, we haven't seen that in construction. The unemployment to job vacancy ratio, which is that blue line, is rising. So again, further confirmation that economic activity has slowed. Wage inflation is a big component of what the Bank of Canada is focusing on. Wage inflation becomes embedded in the economy because when unions get higher wages, it typically leads to the manufacturing companies and the retail companies to increase prices. And so you get wage price spiraling. And that's something that the Bank of Canada is very worried about. They believe that, as they said in their press release, they believe that there is some of the leading indicators for inflation are very troubling, and wage inflation would be one of them. So the headwinds for the economy continue. Consumer non-mortgage debt is rising considerably. Credit card delinquencies, monthly payments have been increasing, and early mortgage delinquencies are on the rise. So inflation remains the focus of the central bank, as always. We have seen the latest data available in September for inflation did tick down from 4% the month before to 3.8%. So that's good news, but 3.8 is still meaningfully above the Bank of Canada's target level of 2%. In today's monetary policy report, the bank said that energy prices have been the most important contributor to inflation dynamics since June of this year. And you see the total CPI numbers since June, and then the energy component, which is that first green bar, which is much, much higher than the contribution in the shelter sector of the economy. There's lots of people that have been saying that the huge rise in interest rates has been inflationary because mortgage interest is part of the calculation of overall consumer price inflation. Well, it is true that shelter has contributed to inflation. You can see that that's a very tiny component in terms of the actual impact over the last 6 months. So, and here we are at the precipice of an all-out ground war in the Middle East, the Israel-Hamas war. That has made many people very nervous about energy prices. And should that war extend beyond just those two countries, there's obviously a serious geopolitical risk that energy prices will rise sharply further. So that's one big unknown in the outlook that we will be watching very carefully alongside the Bank of Canada. And you can see that shelter price inflation is high, but in the last several months, it's been steady. So the fact that mortgage interest has increased, particularly the fixed rate mortgages, those numbers have increased because of just increasing interest rates, market-driven interest rates at the longer end of the yield curve, particularly in the US. Food inflation, thank goodness, has been coming down. However, at 5.9%, it's certainly still very high. And food and energy are the two most visible components of inflation. Most people fill up their tanks and purchase their groceries on a weekly basis, if not more often. And so it's in your face all the time. And remember, just because food price inflation is falling, it doesn't mean that food prices are falling. So no wonder consumer confidence is down. No wonder that consumers forecast inflation, and surveys suggest that consumers think inflation is actually higher than what it truly is, because they are confronted by these very visible increases in prices. The CPI, excluding food and energy, on a year-over-year basis has slowed considerably. So at 2.8%, that was really very good news. But the Bank of Canada likes to look at other measures of inflation. And there we have also seen a dip in the two measures that the bank is looking at, but both are still at 3.7% or 3.8%, still well above the 2% target range. So though recent core inflation measures have softened, they are nowhere near where they need to be for the Bank of Canada to begin to cut interest rates. So today, the bank told us again, second in a row, that they're on the sidelines. 5% overnight interest rate continues. It was a very hawkish statement. They basically told us not to believe necessarily that we've seen the peak in rates. The last time they paused, back in June, July, or actually it was April, May, they didn't say that they could possibly increase interest rates again, and the housing market took off. It was a temporary phenomenon because then they kept putting forth more hawkish statements. Hawkish means they're more concerned about inflation. A dovish statement would be, hey, inflation's down, that's great news, nothing to worry about. We're not hearing that at all. So today, again, we see the overnight rate at 5%. I've also included on this chart in the red line is the inflation rate. So you see, we've moved into the territory where we have positive real overnight rates. The real overnight rate is just the actual nominal overnight rate minus the rate of inflation. And it's been widely argued that monetary policy really is not tight until real overnight rates are in positive territory. So we are there. And you see, this has been, by the way, this 5% rate up from 25 basis points not that long ago, March of 22. This is the highest overnight rate since 2001. So very long time. The prime rate did not change because the overnight rate did not change. So those people with variable rate loans or adjustable rate loans can breathe a sigh of relief that they're not going to see another factor contributing to upward pressure in monthly payments. And the 5-year yield, which also is very important for fixed rate mortgage loan determination of the actual rate, we're well above the 4% mark compared to the last time we talked. This is the direct result of uptick in U.S. inflation. Now, how can that happen? What I've shown you in this chart is the U.S. 10-year yield, which is just shy of 5%. And this 10-year yield has increased very dramatically in the U.S. despite the decline in inflation. And the U.S. economy is running at an extremely hot 5% annual rate in the third quarter. The release of that data will be tomorrow morning. So all eyes will be on it, even though it's history, because if it comes in anywhere near the 5% estimate, that's way too strong for an economy that has tight monetary policy. And part of the reason is foreign dumping of U.S. treasuries. The two countries that have owned the largest proportion of foreign ownership of the 10-year yield have been Japan and China. And the left-hand chart shows you that their overall holdings are coming down, particularly for China, as you see in this blue line. This is a very big deal. And when the U.S. 10-year yield moves up, we begin to see upward pressure on Canadian interest rates, and therefore we see the banks and the other lenders increase more fixed mortgage rates. Whether we like it or not, we're always in a boat that has a huge volatility simply because the big country south of our border, it causes a lot of shock waves. Yeah. And that's likely to continue because the U.S. federal budget deficit as a percent of the economy is at a record high. And so, again, more pressure on interest rates. In addition, with interest rates having increased, the budget deficits will widen simply because the payment of interest on the broadening debt is rising. So those budget deficits are getting bigger and bigger. So that's mostly a U.S. story. It's not quite as significant in Canada, but again, if it hits the U.S., then inevitably we do feel what happens in the wake of what's going on in the U.S. So to the specifics of the housing market, housing markets, of course, have been spooked by rate hikes. Home sales declined for the third consecutive month in September, and the levels are below 10-year averages. And we've now seen a surge in new listings, up 35% since March of this year. So the inventory of unsold homes has been rising, and that is pushing a lot of local markets into more of a buyer's win rather than a seller's market. We've seen that the residential new listings spike here surged 6.9% just in the month of September. And so market balance, this is for the country as a whole, which is kind of meaningless given that each market is, every housing market is local. But nevertheless, if you look at the average price in Canada as a whole, you see that the sales to new listings ratio has come down very, very sharply into buyer's market territory. So home prices edged up, however, on a year-over-year basis, mainly because of base effects, meaning a year ago, the home prices were lower than they are today. So we've seen home prices now year over year edging upward, even though if you look at it over the past 6 months, they're still in negative territory. Now, with new listings rising sharply, we might expect to see softness in home prices in some key markets. But, the fact of the matter is that demand for housing continues to be well in supply, in excess of supply. And so the home price increases are likely over the longer term to resume and continue to steadily move upward unless we can correct the supply inadequacy. Mortgage originations, people are always trying to game which would be better. Should we go fixed? Should we go variable? It's a big decision and no less struggle today than historically. Right now, variable rate loan share, it rose to 13% in July of new originations, up from 8% in April. But if you look back to July 2020, it was at 57% of originations were variable rate. That's incredible. That's historically unprecedented. And now many of those variable loans are deeply underwater. They've hit their trigger points. People, because they have fixed payments, if they haven't made a lump sum contribution to cover some of the principal and the excess interest, the excess of interest owed versus interest covered in the monthly payment. These people are on the precipice of seeing no question that when renewal time comes, they could be owing a whole lot of money. If you look at this, you can see that the 3 to 4 year terms are the most popular now in fixed rate mortgages, and fixed mortgages are more popular in terms of new originations, much more popular than the variable, which is in the blue line here. So big changes in terms of sentiment. Rate paying for upcoming renewals is considerable. Mortgage rates have roughly doubled, if not a little bit more than doubled in the interim 5 years now, and people are experiencing a significant uptick in their monthly payments as they approach the end of the life of their mortgage. The variable rate borrowers are in the news constantly these days. They're the component of homeowners that could be the most at risk. because they are not covering their interest. Their debt is being negatively amortized. OSFI sure doesn't like that. And OSFI has been long telling the banks that, follow this very, very closely. The Bank of Canada has done a study that shows that if banks revert to original amortization schedule for variable rate loans renewing in 2025-26, monthly payments will rise by 40% or more. Now, of course, that's the bank's estimate. They have to choose what they think rates will be in 2025-26 to make that calculation. So it's not a hard, fast number because none of us know where rates are going to be in 25 or 26. But even for fixed rate mortgage payments, they would rise, given the bank's assumptions, to 20-25% increases. So this is a big story. We all know that a lot of people are very nervous about it. OSFI has made all kinds of statements about how they expect more prudent and active account management approach. And they have raised the capital requirements on banks for 2 times in the last 6 months. More recently, though, they've come down the pike and telling us about all of the proposals they were making months and months ago, 9 months ago. But really what they're focused on right now is the variable rate fixed payment loans. And they want to discourage the issuance of that kind of a loan. What they say now is that 17% of all mortgages outstanding are the variable fixed payment mortgages, and 12.4 of these have amortizations longer than 35 years, which could be a huge payment shock at renewal. So OSFI wants to make this kind of mortgage less important, less prevalent. So as of November 1st, just a few days from now, there will be higher capital requirements on the part of the bank's mortgage book that are variable fixed rate, fixed payment, that have been negatively amortized for 3 consecutive months, with loan-to-value ratios of 65% or more. So when they look at risk-weighted assets, that component now is going to be part of those risk-weighted assets. And they have to pay their Tier 1 capital as a percent of those risk-weighted assets. That will certainly increase the mortgage rate on those types of loans, all other things constant. So it'll be interesting to see how that plays out in the actual marketplace. Now, finally, I have to end the formal part of this presentation on another, beating the drum once again, as I do every time the bank meets, that it's not a demand problem that is really confronting Canada. It's a supply problem. We don't have enough homes for people coming into this country, not to mention the existing population. Our population growth is just astonishing. I mean, we're very close to 3% population growth. The US is at 0.5%. The countries that have this level, the 3 other countries have this level of population growth, and all 3 of them are small countries in Africa. It is astonishing when a developed economy has this kind of population growth. And of course, we know it's because of the open door policy, particularly for permanent residents, but certainly in the last couple of years, because of labor shortages, even the temporary work programs have been enlarged, and many temporary workers are still in the country and will ultimately become permanent residents. So this is the biggest factor. And then next month, the government puts forward its planned permanent immigration forecast again. They'll add another year and revise these numbers. And it appears anyway, even with the new Minister for Immigration, that these numbers, if anything, will continue to be very, very large, without considering how in the world are we going to house all these people. And of course, one of the biggest problems is that construction costs have increased very, very dramatically. So construction costs have increased 51% since the first quarter of 2020, and which is when the pandemic began, compared to the CPI up 13% over the same period. And municipal development fees have surged, the labor shortages and rising wages limit supply, and those job vacancies continue in the construction sector. Also, all the environmental changes as a result of global warming, those are expensive. They are very much affect construction costs, and the forest fires reduced the supply of lumber, was very disruptive. Now, the federal government did introduce recently the elimination of the HST on new purpose-based rental properties, residential rental construction. So rental property construction at least has that incentive. But again, it's still nowhere near enough to address the supply problems. And we've seen that construction investment has declined. The overall residential building construction spending has dipped sharply. And the housing starts data are always quite volatile. They did tick up in September, which is good news, but they're nowhere near adequate to meet the current demand, let alone how much catching up we need to do to be able to meet the demands coming in the next few years when immigration is slated to increase sharply. So that's it for me, Eddy, in terms of my formal presentation, and I'm happy to open this up for questions.
Yeah, a lot of information there. So let's first say that if you are looking to purchase, refinance, maybe you are in a variable or you're looking at a fixed, decide between the two. Maybe you're up for renewal and you're looking for some advice. We talked about trigger points and a lot of language that maybe you're not familiar with. Let us help you. We can connect you with one of our mortgage brokers across the country. You can visit www.dominionlending.ca and find a mortgage professional near you. So we have a question. We have a couple questions here, and I have some questions too as you're going through that, Sherry. But we'll get to our first one from Chris Murphy. And he asks, we keep hearing Joe Biden talk about China's economic pressures. Do you expect China to keep cashing in U.S. bonds? Will this keep driving up rates?
I do. I do expect them. Firstly, they're doing it because they know it hurts the U.S. And there's the relationship between the United States and China is at a nadir. I mean, it's very bad right now. And it doesn't help that the Chinese are so cozy with the Russians. So it's a problem. And the Chinese government Chinese economy has slowed very dramatically. So whereas the US is much stronger than expected, the Chinese economy is much weaker than expected. But I mean, it makes sense that they've had a big negative drag on their economy, considering what they did during the COVID lockdowns, which lasted way longer than anywhere else and were much, much more dramatic and onerous. So they've got economic problems, and they want their currency to be one of the major currencies of the world. So they always invested huge amounts in US dollars because that is a hard currency that they could use for trade, because people didn't want their renminbi. But clearly, this has had a negative impact on bonds and longer dated bonds, and therefore mortgages.
Yeah, China, it's one of those economies that affect the entire world. So we'll keep an eye on that one. Really quickly, thank you, FCT, for today's sponsorship. We really appreciate you. We really love you guys. Thanks so much. Again, if you have comments, just put them in or questions, put them in the comment screens, no matter what. Facebook, LinkedIn, Twitter, we can definitely get to your question. So the next one's from Stu Brown. Stu Brown, part of our team. Hey, Stewie. Do you think it be prudent for the feds to include skilled laborers in their immigration plans?
They do. They do that. These are the planned permanent immigrants. They qualify people based on their skill set to fill the vacancies that exist in the economy. And there's no question that they're targeting trained construction workers, people who have had experience in plumbing and electrical and all the other sectors of construction. And there are plenty of those people out there, and they want to live in Canada. I mean, we're fortunate that so many people want to live in Canada. It's just for as big a landmass as we have, unfortunately, we even have vacant land within the municipalities. But for a whole lot of government red tape reasons, it seems to take forever to get a project going, between the approvals and the zoning restrictions and then the development costs. And it's like years, and that has to change. But the federal government can't do a thing about it because it's all at the local levels.
Before I get to Todd Pazan's question, I want to get to Jason Nugent's question. He asked, what jobs are we creating consistently to keep the employment level low?
You mean the unemployment rate low?
Keep employment level, yes.
Yeah, I mean, like our employment level is very high. And we are seeing an increase in jobs in many sectors. And interestingly, the hardest hit sectors right now are the financial institutions. I'm sure you've seen the announcements of the big Canadian banks, the 3% layoffs at Scotiabank and all of the banks. So it's, that's one sector that has really been hard hit. And the other parts of the economy, I mean, healthcare is another one where there continues to be job vacancies and shortages, and mostly in lower skilled jobs, but also nursing. And nurses have just burnt out as a result of COVID and inadequate increase in their compensation. They can make more money in the private healthcare world, meaning, home support kind of nursing and that sort of thing. So, and even there are shortages. So it's a complex problem. Our population is aging. Boomers are retiring. there's also, tremendous demand and needs for student housing, as well as for housing for seniors. And that kind of factor, combined with just the general population demand for housing as the population grows so rapidly, a big issue.
Yeah, and you mentioned before in other countries there's advertising, so the government advertises for certain skills to apply here and immigrate here. So we are looking for them, and hopefully part of the 500,000 are the ones filling those skilled jobs we need. Let's go to Todd Paysan's question. This is asked by some others here. Obviously, a hot topic is, what should I do? And we're getting these questions all the time, Sherry. Should I go variable? Should I go fixed? Are we at the top of rate increases? And it's a hard question to answer, and I understand that. So, and I know that you are more fixed than you are variable for that security. You like to know what you're going to. So this might be a hard one for you to answer, but just a reminder, there is a lot of questions to be asked before you can answer the question. But nonetheless, Todd, here we go. If you're getting a new mortgage, what year term would you take, Sherry?
Okay, so I can't say what I would do because I'm not getting a new mortgage, and I'm risk averse. I've always been risk averse, and I don't like debt. But for young families, obviously they want to minimize their monthly payments. And that's a focus I totally understand. And with any luck at all, these young families will have a growth in their income over the next 5 years. And so they can afford to take some risk. So, that's why the 3-year fixed is so attractive right now, because at least they'll know for the next 3 years what their payments are. And with any luck at all, 3 years from now, rates will be lower than they are today. And so I guess I'd have to say that seems a rational approach.
And you're predicting that rates are going to come down, and you said by the end of the year to 4%. We've heard other economists say
not this year.
Not this year, no, sorry,
next year.
Yes.
Yeah.
So we're going to eventually get to, it's now 5%. A percent lower is what Sherry Cooper is predicting. There's other economists that are going even more aggressive on that. So these are all the conversations you should be hearing. There it is. Ben Tal was talking about, we had a national conference in Toronto. He spoke, and he even went more aggressive and said even 3% is possible for next year. So there is that to have those conversations around is, how open are you to a little bit of risk to maybe benefit from these lower rates? So that's a question that needs to be answered, and you can go from there. Let's get to our next question from Simon Bilodeau. Is it possible that low unemployment is due to a large number of people retiring?
Yes, it is. But what the Stats Canada people do is they calculate what the size of the labor force. Okay. And unemployment is just the number of people in the labor force that don't have a job. But if you've left the labor force, retirement, for example, you're not supposed to be accounted for in those data. But nothing's perfect, and they don't, they use survey data, they adjust it as they get more information. But there is certainly, in fact, that in the September labor force survey, they had a special appendix that looked at the impact of both retiring boomers and new immigrants on the actual unemployment numbers.
Makes sense. So our next question is the upside to this immigration is the opportunity to turn basements into rental properties with the government approval. So it's more of a comment, and the opportunities are, yeah, absolutely. If you are an investor, and hoping to maybe subsidize your mortgage by renting out your basement. These are all great ideas, and obviously you're going to help house more Canadians. What are your thoughts around maybe switching your rental property or maybe renting out your basement?
Well, yes, but you see, you do need to get approval for that, and that takes time, and you may or may not get the approval. It depends on your neighborhood, right? And you can't just go ahead and do it and assume that it'll be okay. Some properties lend itself, if you have a separate entrance to your basement.
Yep.
It lends itself to being a home, like creating basically a duplex in a single family home. But there's all kinds of ideas, laneway properties that
garden homes.
Yeah.
There's tons. And by the way, there is financing programs for these types of changes. So again, visit www.dominionlane.ca and we'll put you with a broker that can give you some options when you're thinking about rental properties, converting basements, garden homes, or laneway homes. Definitely want to help you with that financing. Okay, let's go to a question on the government in the U.S. practicing yield control. How would this impact us? So are governments actually practicing yield control? I don't know.
No, they don't, and they can't. Yeah. Nobody has the market power to significantly affect interest rates over a stretch. These markets are trillions of dollars big. So they're not pegging interest rates. They're just, the government, the central banks peg the overnight rate. That they can handle. All that is an interbank market where they borrow excess cash from each other if necessary. And the Bank of Canada sets that rate because their excess cash, their reserves, are held by the Bank of Canada. But when you open it up to market-driven interest rates, there's no single entity. Now China could dump all their US treasuries and, oh my God, interest rates would skyrocket. But they would be selling these bonds at crazy low prices. So why would they do that? They wouldn't. So it's not a control situation. It's just markets are interconnected worldwide. And when the US sneezes, everybody knows that Canada catches a cold. We all know that. And so, we get the benefit of that as well because the US is our major trading partner. And if their economy is super strong, they'll buy more goods from us.
Oh, absolutely. Next question comes from Roy Cocciollo. Same last name. He is my brother. I don't know if this question is going to be one that I admit that he's my brother, but here it is. The affordable housing program. So government keeps on talking about affordable housing. We know that affordable housing is a tough one. How feasible will these implement in reality, Sherry? Are these programs?
It depends on the location, but if you're talking the Toronto, GTA, or Greater Golden Horseshoe, or Vancouver, or Victoria, or any of the other very expensive locations, you're not going to have affordable housing. I just can't see how that would happen.
Yeah.
And it would have to be subsidized heavily by the government.
Yeah. No, absolutely. Carlos Lerma. So I'm going to try to give the Coles note here. He's talking about the expectation in terms of inflation and GDP. Are they reasonable? Is those targets going to happen? I know they've changed them a couple of times, but now we're talking about 2025. That'll be down to 2%, and GDP growth will shoot up to 2.5%. Reasonable? Think it's going to happen?
It is. The bank's forecasts aren't very different from what you would see at any of the other forecasting shops, like the chartered banks or independent forecasters. They're not far off of what I would suggest but remember, none of us knows, because it's a human bias to assume that what has happened will happen. So it's called adaptive expectations. But the things that impact markets the most are the things that are unexpected. And so if everyone expects something, then it's already in the market. But it's the things that no one expects that make the biggest difference. And because none of us know in this volatile, turbulent world what will happen in 2025 or 26, it's an educated guess at best.
Yeah, no, it's like the weather, right? We try to do our best to give you that forecast, and hopefully you can enjoy the day or stay home. We get it.
And we're much better at forecasting weather for tomorrow than we are
right, exactly.
2025. So
I think this may be our last question. With the recent news by Aussie indicating renewals on existing insured files going forward can essentially waive the stress test and qualify at the contract rate, how will this impact Canadians renewing in future years? So Aussie indicated renewals.
What they indicated is that if you have an insured loan that you qualify for initially, of course, that if you don't renew, if instead you want to refinance, you don't have to be stress tested again.
Right.
So that is likely to encourage more competition, which is a good thing for the borrower. And it's interesting. And I'm not sure that it'll always be this way in the future, because it sounds a little bit like a loophole, but it is relevant.
Yeah, absolutely. Okay, Sherry, thanks so much. We want to thank our sponsor, FCT. Obviously, our listeners, thanks for joining us again. Our next announcement, or the next Bank of Canada announcement, is December 6th. That'll be the last one of the year. I don't know. Are we looking forward for this year to kind of go by and hope for new beginnings next year? Or is it still going to be a volatile year? I think it's going to be a tough year next year as well. What are your thoughts?
I don't think as tough, but
I like that. Not as tough. So
we're
we're
early in the tightening cycle. We're late in the tightening cycle.
Yeah. Exactly. We're positive in going into 2024 to be we're going to hang on those words. Sherry, thanks so much, everyone. Until next time, we'll see you. Take care.